Good morning. We are half an hour from the open in Hong Kong, Shenzhen and Shanghai. You're watching The China Show. I'm Rebecca Choong Wilkins with David Ingles.
Good morning. Our top stories today. Investors bet China's tech sector crackdown is ending. That's after Chinese President Xi Jinping's meeting with leading entrepreneurs. The president pledging to abolish unreasonable fines and level the playing field.
And Australia's central bank is widely expected to cut rates today for the first time in 4 years as price pressures recede.
Also ahead, and speaking of Australia, we speak to Mike Henry, the CEO at BHP, after the company posting this almost a 0.25%, 23% to be more specific, drop in first half profit. That's really on lower demand out of the Chinese.
Plus, fast fashion retailer Shein is said to be under pressure to cut its valuation while facing a bumpy ride to its potential UK listing.
Right, so welcome to the show. Equity markets are largely, I was about to say largely bid, but we've just come off a little bit right now on the Kospi index. I'll get to you. I'll show you what Samsung's doing certainly in a moment. Keep in mind, of course, we're coming off a holiday in the U.S. We're not really getting a strong leader, although if you judge it by what happened in the European session, we are extending somewhat some of the gains there. And by the way, the European market is also one that's really stood out. And speaking of the other one, which is China, which we'll get to in a moment here, we're flat across the benchmark itself, although in terms of market breadth, you are getting a lot more upside. Nikkei 2254, 0.1%. To the upside, we have a rate decision today, as Rebecca was pointing out just earlier on at the top of the show. Steeper on the curve. We are expecting the first rate cut since 2020 out of the RBA. It's certainly guidance is going to be more important. That's a day, of course, ahead of the RBNZ. That is also expected to move by another 50 basis points for a third time. I guess we can talk about that. We can talk about that tomorrow. There's a BHP conversation, of course, on the back of weak Chinese demand. Most metrics, financial metrics, were actually pushed to the upside for the first half, although, of course, it was really that 23% drop in profits which caught the attention, and the cut in the dividend as well. That said, of course, we have reversed a lot of the weakness that came through in the early goings on BHP. TSMC is coming online. Aspen Samsung is flat there. Nissan, of course, do we get to talk about the potential merger again? Maybe we'll see. That's according to the EFT if the CEO leaves. Very, very quickly, the approach to the Chinese markets right now. So, I mean, if you compare where we are in dollar China this time yesterday, we're certainly on much higher levels. We did bounce off that 100-day moving average. The other thing I want to point out, though, as we sort of digest what the sort of second derivative effects of this AI rally might be, this pullback in, a very crowded long CGB trade. We're at 1.7 right now, which is the highest level on a 10-year yield this year so far. And really, this 4 or 5 straight-day pullback in CGBs comes amidst this rally that's taking place. And as you can see, that is set to continue going into today. And, of course, the other thing I want to point out is we have Baidu coming out with earnings today. So that's sort of your first tangible landmark on this AI that we're going to be hearing, of course, from that big corporate later today, Rebecca.
Yes, thanks, Dave. I mean, I just want to pick up on your point about CGBs there and what we're thinking about watching today. Really, of course, we have seen this relentless rally in bonds, but now they're looking a little bit expensive when we take that alongside the context of the stock rally we've seen driven by optimism around AI, by the DeepSeek move that you were mentioning, Dave. But still, saying that, we're still eyeing the HSI. It is really struggling to get above that October level that we've seen. 2309 is the level that we're watching to see if we can close at a level that surpasses that October high. The context here, of course, for yesterday is this big symposium we saw Xi Jinping meeting with tech and other entrepreneurs and the private sector, essentially a voucher of support. Does look like yesterday, to Dave's point, that we're seeing a little bit of profit-taking when it comes to Chinese markets, at least. Elsewhere, geopolitics, we have Wang Yi now in New York. He has been on this sort of big charm offensive through Europe. He was at the Munich Security Conference. Really, it's his pitch of China as an alternative to the US, as a bastion of free and open trade. Elsewhere, data-wise, we have Hong Kong jobless unemployment data coming through, and we are now in the window for MLF. Just bear in mind now, in recent months, the timing for that MLF has actually been a little bit more uncertain. So we're really watching from now until roughly the 25th or so. But Dave, yeah, sticking back to this meeting that we saw yesterday, there was really this feeling that perhaps it would be this strong kind of vouch of confidence that would help drive and sustain some of that momentum in markets, Chinese markets. We didn't necessarily see that come through yesterday. Maybe just a little moment of caution, maybe a little bit of profit taking. Let's talk more about that meeting, who was there and its significance. We'll bring in our China correspondent, Min Lo, in Hong Kong. I mean, let's start with the attendees, a rather sort of grand array of entrepreneurs and kind of tycoons.
Yes, all the who's who in the private sector, from a range of industries ranging from robotics to mobile phones companies to AI to EV. So CATL, BYD, the founders were there. There's Alibaba's Jack Ma, Huawei's Ren Zhengfei, Xiaomi's Lei Jun, DeepSeek's Liang Wenfeng. So a bunch of them there. And President Xi was there in attendance together with Li Qiang, the premier, as well as a couple of other standing committee members of the CPC Central Committee. So very high profile. The last time President Xi hosted something as high profile as this was back in 2018, where there had also been some concerns over the state of the private sector at the time. And this time he listened to the opinions of about 6 of those industry representatives, and he gave a speech. And what he said, I'm going to quote you, he says, it is a prime time for private enterprises to give full play to their capabilities. The private sector enjoys broad prospects and great potential in this new era. So essentially, in layman's terms, he's telling these companies, we want you to keep boosting consumption, keep innovating in this climate where China is engaged in potentially a new trade war with the United States and a tech race as well. He also mentioned a few very specific measures that the government is pledging to take, including rectifying these random fines, inspections, seizures of companies to protect the legitimate rights of these companies. This after we heard reports of local governments sometimes imposing hefty fines when their coffers are low. He also said the government will make efforts to solve the problem of expensive financing and also make the playing field fair, promote fair market participation for these private players.
Jack Ma was in the room. What's the significance of that?
I can tell you that that's already generated a lot of chatter on Chinese social media because Jack Ma is arguably the most high-profile face who had suffered under that tech crackdown several years ago. So he had largely stayed out of the public spotlight for several years. And now that he's back out on Chinese social media, people are saying, I'm shocked that Jack Ma was there. This is good news. And very positive sort of exuberant kind of tone on Chinese social media. And it's significant because it's perhaps the most public show yet of this culmination of the multi-year crackdown after the government wrapped up the antitrust investigation and slapped a $1 billion fine on Ant. They now invited Jack Ma to take a front seat among that list of attendees, among the business executives. He was one of those who got to shake hands with President Xi. Not all of them got to shake hands. So it's pretty significant, and it suggests that Alibaba is now back in the good books with the government.
Min, thank you so much. Min Lo getting us set up here for the trading day ahead, the Tuesday session, just 22 minutes away. Our China correspondent there. Joining us here on set to talk us through the implications of this, plus other market themes globally, Ecaterina Bigos, CIO for Asia, ex-Japan, core investments at AXA Investment Management. Nice to see you, and good morning.
Good morning.
Let's start with China. Now that this risk premium's market's been liberated somewhat of the premium, what now? How do you look at the market right now, 30% into the rally?
Yeah, of course. I mean, I think we have to break it down a little bit to look at where the rally is coming from. And again, it's very concentrated, as we know. The positive since the beginning of the year has been the DeepSeek innovation. I think it's excited a lot of market participants and corporations in China about the potential implications of that on a corporate sector. And again, in the longer term, that can have implication on productivity, again, new business, new revenue streams. And then, of course, we've had the meeting of Xi with various tech leaders at the broader tech industry. And I think that's a positive. I think it shows that the goals are aligned. But again, the market hasn't not taking it with additional, let's say, support in a rally sense, again, because we've had a meeting in 2018 And again, the consequences or the evolution of that has been somewhat different to what was, again, stated in 2018. I think it's a positive, but I think we have to be cognizant that the aim for China, I think the goals are aligned, and the aim for China is still common prosperity, is technological advancement, and the realization of the government that tech has a big contribution to that. And I think this is a positive.
I want to ask about and sort of shift gears to think about that a little bit more in the context of tariffs and Trump coming in. You know, in December, we saw the PBOC shifting its monetary policy stance, the most aggressive in 14 years, promising RRR cuts. The PBOC has sort of talked the talk. It hasn't walked the walk. And to some extent, there's been this relentless focus on instead prioritizing the stability of the yuan. How do you think investors are reacting to this? I mean, are they surprised, confused, disappointed?
Well, I think there's a limited room, I would say, for PBOC at the moment to move aggressively, purely because, again, the Fed is on extended pause, if you might say. The monetary policy, we had indications that, again, the economy in the U.S. is stronger. The inflation is still resisting around the 3-point level in the core side. So, again, with Fed being on pause, again, puts a little bit more restraint to China and the ability of China to continue easing without pressure on its currency. And I think the second part is what are going to be the next steps for the tariffs. I think the market is certainly not believing that the 10% was the end of the tariffs between the U.S. and China. And I think this is somewhat preserving some ammunition to understand what are the implications of the next stage of these tariffs to continue to ease with the monetary policy. I think ultimately, and we've said it before, fiscal needs to do a lot more, and fiscal needs to do a lot more in a kind of a demand side, i.e. doing more for the consumer. And I would say if I had to kind of expand a little bit, the tech positive leaning towards tech, it's somewhat an indication that they're willing to do a lot more demand type of support the confidence, support investor confidence, but also support private sector and consumers. Yeah.
That's a good point that you make on essentially trying to preserve ammunition when it comes to tariffs. Do you think that this potential for tariffs or tariffs that we're expecting to see, are they forcing the PBOC to break its promises? And are we seeing a new playbook from the PBOC when it comes to dealing with the trade war?
Absolutely. I mean, look, there's a new playbook because there's no other playbook. In the previous trade conflict, China was in a different state. It was an economic state, but also the monetary policy in a different stage. So at the moment it's a wait and see. They need to see how the tariffs, what the implication, what the size of those, the timing of that is, to kind of craft their own monetary and fiscal policy accordingly.
What other things are happening right now? I mean, this exuberance in Chinese markets might be sort of overshadowing other market themes right now. What else is on your mind?
No, I think the broader tech, it's staying as a theme that is going to drive global investment, I think, for the next couple of years, if not a decade, because I think technological innovation and advancement is at the forefront of many economies. And I think what DeepSeek has provided to investors is that there'll be more players to it. And clearly, particularly in AI development, when we look to build these models, US will build their own models in English. Probably there will be Chinese that will build some models in English and some in Chinese, because, again, they need to cater to their own demand, right? So there will be certainly a lot more broader spectrum of players into this field that investors need to capitalize on. And, again, the ramification of it at the moment is that it's still in a stage of development, it's still in the stage of training those models, and those still have implication on building system, building the infrastructure, and still has a positive impact on a broader Asian economies, places like Japan, places like Korea, potentially Taiwan, that are part of that supply chain of building the infrastructure and the ecosystem for tech development.
We've already seen DeepSeek being banned from government officials' phones, in various countries. And, of course, this concern and this theme of sovereign AI. I just want to ask, to what extent do you think these national security concerns are going to hamper the development of the diversity of what we see and also the ability for investors to be moving into new markets?
No, absolutely. And this is a key concern. And again, the excitement is there. I think the potential for AI is certainly there, as I said, in terms of the ability of AI to enhance productivity, to provide new business lines and new revenues. But we need to look at, again, data security will be a big concern. We have to look at DeepSeek as an open-ended. Again, anybody can build on that platform, and that's a consideration on security. And as we go further down the line, national security, data privacy, these are concerns that are still present. Again, beyond the fact that the excitement and the potential value of AI is still present. And then we have with the models themselves, the data in which those models are getting trained, the hallucinations that they have, or the data output that they potentially have that could be misleading. So there's a lot of still things that needs to be hashed out till we get to the end point where AI it's really manifesting in the industries. I think at the moment it's still very much about tech, infrastructure, building, training, and getting to that AI models that are right for particular industries or particular countries. Yeah.
Ecaterina, thank you so much for joining us today. That's Ecaterina Bigos, CIO for Asia ex-Japan Core Investments at AXA Investment Managers. And still to come, Chinese social media app Red Note surge in popularity amid uncertainties surrounding TikTok. Now it's getting tips from Chinese authorities on how to get a possible listing approved. All those details will be coming up next. And we're counting down to the open of trade in Shanghai, Shenzhen and Hong Kong. We're about 15 minutes off that, so stay with us. This is The China Show. Good morning. You are watching The China Show, and China IPOs in focus today, Dave. We have the fast fashion retailer Shein said to be under pressure to cut its valuation to about $30 billion. That's half of the level seen back in 2023. Meanwhile, Chinese regulators are also said to have formally indicated to Xiaohongshu that a state-owned investor could help smooth approvals for a future listing. We have Manuel Bagori, who leads our Asia-Pacific deals coverage, and joining us now. I mean, let's start with where we are on both of those potential deals. What's the state of play?
Rebecca, thank you. I mean, they are both very much up in the air, I would say. Bottom line is, it's unclear the direction of travel for both. Take Shein, for instance. Who doesn't love fashion, right? But the reality is this company, formidable startup that has grown through the roof over the years, it's faced by a lot of issues globally, particularly in the U.S. With regards to supply chain, labor, and so on. And the reality is, last year, as we reported, they had to reroute the IPO plans from the U.S. into London. Now, the reality is not that easy either, and investors are realizing that the valuation that they were aiming for, as you well said, it was slightly more than double about a year and a half ago, and it was more than triple 3 years back. They're coming to terms with it, and they're realizing that if they want to get a deal done, they have to lower the expectations. So now they are talking about $30 billion. We'll see whether that stays or they need to even bring it lower. I think it's still up in the air. There is a lot of question marks. Definitely there is an intention to float in there. They filed confidentially in the UK, as we reported last year, but there is a lot of moving pieces here, and it will be a fascinating story to cover to see how it unfolds.
To what extent is that adjustment and recalibration of expectations that we're seeing at Shein, to what extent does that reflect the overall sentiment in the market? I'm thinking, I guess, not just IPOs, but also for M&A.
That's a good question, Rebecca. I mean, the reality is valuations, were a little bit toppy, particularly for some of these startups that were expanding exponentially globally. And the markets have adjusted, and particularly private investors are being a little bit more cautious when it comes to deploying capital. Now they have to be able to withdraw some of that. They have to deploy some of that to their own investors and show returns. Now an IPO in the case of Shein could be a way into it. You also mentioned mentioned briefly M&A. We are seeing valuation being, as always has been, perhaps even more so now, a sticky point in negotiations. Now the question towards 2025 is whether there will be an adjustment and buyers and sellers will be able to meet in the middle. It's still too early to call on that regard.
And when it comes to red note, also known as Xiaohongshu, this potential for having a state-backed investor or support in some way, how unusual is it to see that kind of smoothing the wheels when it comes to an IPO? And do you think that there's any receptivity to that idea?
Certainly. I mean, we have seen that in the past. Take other unicorns we've been covering over the past few years. It is true that Xiaohongshu is one of the few remaining ones, big Chinese tech unicorns that remains unlisted. So everybody is kind of focusing on that. We've seen that in the past. We've seen some of the big tech companies bringing in state-owned backers, not necessarily the parent level of the company, perhaps more through one of the units. And that's an indication from Chinese regulators, informally, but an indication that perhaps bringing in a state-backed investor and aligning the company's plans with those from the government and from regulators can also help pave the way for a potential transaction. But it's still very early stage on that one as well, and it remains to be seen whether or not the company will follow that indication.
Manuel, fantastic. Thank you so much. Manuel Baigori there, who leads our Asia-Pacific deals coverage. So lots of progress as far as the deals front's concerned, regulatory, and of course the momentum coming through across these markets. We're higher in your pre-markets. A full preview of the Tuesday session is just, coming up right after on the other side of this break. Stay with us. This is Bloomberg. Right, welcome back. Going into the open today, focus is on tech, and it's looking like, it's a normal-esque day. It's been a while since we've had really not big moves across in either direction, as you can see, going into the open today. Right, three charts to watch as we go into the open today. Southbound flow, certainly how much money is coming across the stock connect. We did see a spike into the afternoon, into the close yesterday. Watch this as an indication, leading indicator really of momentum on a very short-term basis, of course, in the equity markets. Right, in terms of stock valuations, because of the rally, that's the next chart coming up. We've actually now snapped back to right above the mean. So watch it very closely. How do the markets really feel at this point in time? Momentum, finally, of course. And there have been periods of re-rating, and it's just worth pointing out that this market, while it is overbought, can remain overbought for some time. So we're going on 2 weeks now. That was about 2 weeks. That was about 3 weeks. Right, so going into the open today, we are indicated higher on the Hang Seng Index, 50 points to the upside. So we're then about 1.7% of ticking out the October high. So plenty more ahead, including the opening bell. We'll speak with Goldman Sachs on the other side of this break. This is The China Show. Good morning.
Good morning. You're watching The China Show. Welcome back. We are counting down to the open of markets today. We saw a little bit of respite, a little bit of profit taking yesterday in Chinese markets. Really, again, the focus today is whether or not we see momentum sustained in that tech rally day, particularly after we had this symposium yesterday. President Xi Jinping sitting down with a whole host of prominent, mainly tech names in China.
Yeah, the optics on that one, really encouraging. If you really take a massive step back a couple of years, and why a lot of these stocks, while they have rallied, are far off their highs. The regulatory story is concerned, and has that overhang now been completely removed with that sort of symbolic meeting that took place. The other thing I want to point out on the tech story, on the AI front, is Baidu's reporting today. So watch for what they, not just what they report, but what they say as well on that. The other thing I want to point out to you, when you look at mainland markets, is we had the 10-year yield somewhere there. Yeah, there we go. Top row on the left side of your screens at 1.7%. That's now the highest of the year so far. I think we've backed up for 4 or 5 days, and it's taken place against the backdrop of the AI rally. So is that getting funded through that? That's certainly one question to posit at this point in time. The Hong Kong Open is this. Let's have a look at that, please. We were higher. There we go. HS Tech is up 0.2%. MSCI China is at about 0.1%. Just keep that figure in mind. 73.65. Goldman Sachs put out their new target at now 85. We'll get to that in a moment. Tencent, Alibaba, bottom of your screens. Meituan also seeing some gains there. We are extending, by the way, that 3.5-year high that we closed out on Monday on Tencent. So again, 500 is the level to watch. I think we were slightly above that at one point in time yesterday. Alibaba, 1.7%. Very, very quickly, Xiaomi of Hua Hong, which did very, very well in the Monday session, continuing to see some upside at 1.7%. And, of course, Bilibili, which is effectively still also part of this broader trade. Right. Okay. Some revisions out of the folks at Goldman Sachs from 75 to 85 on MSCI China, 4,700 from 4,600 on the CSI 300. Joining us here now on set to talk us through these revised assumptions and targets and projections, Kinger Lau, Chief China Equity Strategist at Goldman Sachs. Good morning and nice to see you. So, yeah, just take us through the thesis here.
Well, I think the new development here, obviously, is AI, right? The DeepSeek emergence. So we did some work and tried to quantify the potential AI impacts on the markets on really 3 dimensions. Number 1, earnings. Number 2, valuations. And number 3, flows. Now, on earnings, we think that the application of wider adoption of AI could boost Chinese corporate earnings by about 2% per annum over the next decade. So obviously that's conducive to corporate fundamentals. On valuations, now conceptually, if you have a better growth profile down the road and allowing for some confidence improvement, as you said, the symposium and other regulation changes, we think that the equity market could re-rate by about 15% from here. So just taking these 2 inputs into our index forecast calculations, we can get to 85 from 75. That's why we revise up the targets.
What about some of the potential headwinds, or what are the what are the assumptions that you're making? I'm thinking about things like concerns about monetization, for example, concerns about the implementation of DeepSeek and others overseas.
Right. So that's on tech. But if you take a step back and really think about or try to make sense of why China has done well so far this year, I think it is really coming down to 3 reasons. Number 1, moderating concerns on U.S. tariffs. Number 2, obviously AI. But number 3, very importantly, is the expectation that policy could be more forceful in terms of supporting growth. So obviously we will get more visibility on that or more details on that in the upcoming 2 sessions. But when it comes to risk, I think if there's any disappointment regarding policies or any kind of intensification of U.S. tariff concerns, I think obviously that would put some pressures on the market.
I mean, that's a good point about, the expectations that policymakers are trying to manage here. What do investors need to see from the MPC to sustain this momentum in the rally?
Well, we've been telling the story that the policy pivot in September last year basically put a floor on the market. Basically, there's a policy put option underwritten by the Chinese authorities. But now it's a time that they have to deliver the policy to the market, right? So when it comes to the upcoming MPC, we do expect some specific numbers to be unveiled by policymakers on fiscal policy. We expect fiscal stimulus to be quite forceful in terms of on-budget fiscal deficit as well as the broad augmented fiscal deficit. So that's the time for us to get more details.
How much foreign participation have you observed as part of the recent rally? I just want to get a sense of what foreign investors are thinking about this right now, how they're doing that.
Well, based on the numbers that we can track, obviously we've seen some pickup in terms of foreign investors' positioning in Chinese equities. If you look at hedge funds positioning, it's gone up from 6% to almost 8% now in terms of the net risk exposures to Chinese stocks. Okay. Also, we have seen some improvement in allocations from mutual funds in Chinese equities. They're still underweight, but they are
still
less underweight.
Okay.
Yeah, they're still net underweight, but less underweight than before. And obviously, southbound has been pretty strong, right, for all the numbers that we can track. So I would say activity level definitely has picked up.
And on the tariff risk here and how, I suppose, investors are recalibrating, as you say, it hasn't been as bad as some expected, but consensus generally is still that we get to somewhere like 20% or 30% tariffs through this year. Do you think that's priced into Chinese markets?
Well, let me say this. When I was doing kind of the global marketing at the end of last year, I think at that time, investors' consensus probably is around 40% to 50% rise in tariffs, right, from the U.S. But when we had our global macro conference in Hong Kong in mid-January this year, we did a lot of polling questions, and the results suggest that at that time, people were already talking about maybe 15 to 20%. So I think if you try to quantify consensus, maybe 20% is the consensus right now, and which is, by the way, is consistent with our base case assumption, which is 20% rise in effective tariffs from the U.S. And so far, we've gotten 10, and that suggests that maybe another 10% is yet to come.
Right. So at the top there, we showed that you've revised your target both on MSCI China, which is mostly, let's say, mostly a Hong Kong story, and CSI 300. What do you think of this valuation gap that's closed between A and H shares? Do you think that can continue? The premium shrunk because it's really been concentrated in Hong Kong. What do you think happens with that gap? And are you concerned about concentration?
Well, obviously, Hong Kong has outperformed the Asian market in the latest rally, and I think that can be justified by the representation of the index in Hong Kong, right? You have more internet companies, more application names that you can play when it comes to the AI optimism. But when it comes to the target valuations, we raised the number for Hong Kong to 12 times. But we maintain our 14 times target multiple for the Asia market. So these numbers suggest that there will be a valuation gap still exists between the two markets. And I think the upcoming two sessions will be an important catalyst for the Asia market to catch up. Because historically, the Asian market has been more sensitive to policy dynamics, to more liquidity dynamics, and which we think will be more positive after the MPC.
Right. What about the other themes that have rewarded investors in the past? You know, dividends, SOEs, for example. How are you thinking about those trades right now?
We still like the shareholder returns theme, as I said many times in this show before. I mean, Chinese corporates are really returning cash to shareholders. Last year, they returned more than 3 trillion RMB back to shareholders, and this year we expect that number to go up to 3.5. So against the backdrop, you just talk about 10-year bond yields in China, 1.7, and if you can get pretty stable and consistent sort of shareholder return cash yields at about 5, 6, 7%, I think that's still very attractive.
Would you consider those defensive trades? Sort of the one I want to get to is, has sentiment turned enough that defensives take a back seat at the moment?
Well, I don't think this is a binary decision, right? Okay. Either you can go just buy the SOEs or high div strategies, or you buy AI. I think you can definitely find some sort of intersection between the two. And telecom companies, I would say, is one of them, right? Giving you pretty good yields at the same time can benefit from the AI story.
The DeepSeek story was something of a wild card that I think few people necessarily sort of had, on their bingo card this year. I mean, to what extent do you think that we might see more of that? And I guess, do we see DeepSeek kind of bringing in a new generation of kind of very innovative, often Zhejiang-based firms coming through? I'm asking because Winnie Wu from Bank of America had this interesting idea that this is sort of the beginning of a whole new generation of Chinese innovation and Chinese firms that is going to drive capital towards Chinese equities.
I would concur with that. Obviously, there's still a lot of uncertainty in terms of how we monetize and how we use AI. But as I mentioned earlier, if you think about really the medium term to long term, I think you can make a pretty credible case that AI should be conducive to corporate earnings, right? So, I mean, there's the optionality, I think, is not fully priced in the equity market.
What's the risk we don't see? What hasn't this changed? What remains still a wild card for you?
On AI or?
Well, because of the exuberance around AI, for example, it tends to sort of overshadow some of the risks that remain in the market. What do I need to be attuned to right now?
Well, I would say still China-US tensions or relationships, particularly tariffs. Right. I think at the moment, market seems to be a little bit more relaxed about the tariff concerns than a few months ago. But obviously, there's still a lot of uncertainty around that. So we need to get more details, more visibility on that to make a case that the equity market rally can sustain.
Okay. Kinger Lau, Chief China Equity Strategist at Goldman Sachs, joining us there. And there is plenty more ahead. You're watching The China Show. Good morning. This is Bloomberg. Ukraine's President Volodymyr Zelenskiy says peace with Russia needs security guarantees. Bloomberg News desk editor Jill Desis is with us. Jill, we had this discussion between Zelensky and Macron. What is underpinning this anxiety?
Really, a lot of this just comes down to how much Europe is actually going to be involved as we kind of work through some of these peace talks. It seems that the Europeans were pretty surprised by the pace at which Trump's administration is working with Russia to try to get some kind of a negotiation underway. We know that U.S. and Russian officials are actually expected to meet later this week. Maybe that paves the way for a Trump-Putin meeting in the future. But at this point, Europe seems to be kind of caught off guard by whatever is happening with potential Ukraine peace talks. We do know that we've got this meeting that Macron sort of hastily called in Paris, trying to get some European leaders together. It does seem like there's a little bit of anxiety within the EU about who among those member states were actually able to sort of attend this meeting. But what we're at least hearing from the Ukrainian side is that they do want Europe to kind of get involved because otherwise it kind of seems like they risk being left behind here.
So what do we know about this potential peace summit? When? How? Who'll be there? Just the probabilities I should be attaching to this.
So at this point, what we're waiting on is this meeting between U.S. and Russian officials in Saudi Arabia this week that kind of sort of paves the way for something in the future. Maybe that ultimately leads to a summit, again, between Trump and Putin himself. Obviously, Trump made a very big deal during his campaign about the fact that he wanted to end the war in Ukraine on day one. Well, it does seem like he's moving at least fairly quickly in terms of trying to negotiate something. Again, how much Europe is actually involved in any of those talks, I think, is something to be, sort of left to be determined here. What we have heard, out of Macron so far, there's no formal conclusion from this Paris meeting, but they do seem to be drawing up a response. We'll have to see what they get involved in from that point. But yeah, I mean, obviously things are moving very, very quickly this week. I think that meeting between those U.S. and Russian officials really seems to be something that, we're waiting on for what those formal next steps ultimately look like.
Jill, thank you so much. Jill Desis, our Bloomberg News desk editor. In fact, just on the point Jill was making right there, the graphic you're seeing on your screens is really, how quickly things are moving. The market's also caught off guard by this, right? This is a basket, Goldman Sachs basket of defense stocks surging. As you can see, the edge of that graphic there just shows that things going absolutely just vertical on the Monday. So certainly, that's a group to watch as we go into the Tuesday session over in Europe. Right, now, just on this, that story we just mentioned there. So Donald Trump's top foreign policy officials are, in fact, in Saudi Arabia for talks with Russian counterparts on Tuesday to push the president's plan here to end the war in Ukraine. Meanwhile, though, you have a top aide to the Ukrainian president, Volodymyr Zelensky, says Kyiv wasn't invited to talks in Riyadh. The deputy head of Zelenskyy's office tells Bloomberg it's dangerous to leave Ukraine out of these negotiations.
We can say that now United States is involved deeply in the process and are looking forward. The main thing for President Trump, as was said, to ensure the peace, that it is reliable and stable, so that this war will not recur in any form, in any type, just in 1 year or in 2 years after its completion now.
And I'd like to get your perspective on Trump's approach, engaging directly with Vladimir Putin. I'd like to get an understanding of, obviously, he's setting up this meeting potentially in Saudi Arabia. Will Ukraine be a participant in a high-level meeting in Saudi Arabia with the Russians?
Look, our side and our country was not invited to the meeting, so there will be no representative, from what I know, as of today at this meeting. And it makes the situation, I would say, dangerous because, firstly, and it's obvious, it stands to reason to expect that the talks should be held first with Ukraine to hear our position, to hear what we have to say, and then so the main thing is to avoid these backdoor channels, this back dealing. It doesn't help the situation, and you have to understand the mind of the people who you're meeting with before you can proceed. That's important.
Could you imagine a scenario in which some of these sort of requirements are met and Zelensky could meet with Trump and Putin later this month?
Well, everything is possible now. You know, we live at this speed that is just within our reach sometimes. And if this meeting is to take place, it should be properly arranged. And every party should get the notice well in advance where this meeting is to take place and what is the agenda of this meeting, so that we can move forward on that. So it doesn't work, you know, that you say, well, tomorrow we meet in some place and everyone will go there. It's not a fair approach. I suppose, and I believe that preparatory work is to be done just before everyone's getting.
Ihor Brusilo there, an aide to Ukrainian President Volodymyr Zelensky, speaking with our colleague Oliver Crook. And here are some of the other global stories we are following this morning. Singapore's Prime Minister Lawrence Wong is expected to boost spending in his first budget, offering more handouts to households and businesses ahead of an election. Tuesday's budget is likely to focus on bringing down living costs and increasing social aid. Wong, who is also the finance minister, is expected to detail measures to help businesses focus more on artificial intelligence. Myanmar's military government says it's ready to hand over about 1,000 foreign nationals rescued from cyber scam centres near the Thai border. The victims are mostly from Asian countries, including China and India, while others came from East Africa. Myanmar's junta has launched a military operation to combat online scams under pressure from Thailand and China. At least 15 people have been injured after a Delta plane flipped and came to rest upside down after landing in Toronto. The plane, flying in from Minneapolis, had 76 passengers and 4 crew on board. According to local paramedic services, 3 passengers are in critical, non-life-threatening condition, while the other 12 sustained mild to moderate injuries. There is plenty more ahead. You are watching The China Show. This is Bloomberg. Good morning. You're watching The China Show. Here are some of the other stories that we are following out of China this morning. Beijing is calling for the U.S. to reverse a decision to remove a reference to the status of Taiwan from the State Department website. A line in a fact sheet that stated the U.S. does not support Taiwan independence was removed last week. Taiwan has welcomed the move, but the U.S. State Department says there's no change to Washington's One China policy. Tesla has reportedly been told there's no definitive timetable for Chinese regulatory approval for widespread training of its full self-driving technology. According to the FT, the main reason is that officials are contemplating the use of approval as a bargaining chip in trade negotiations with President Trump.
All right, for a look at markets right now. So a couple of generally speaking, it's a quiet day so far, and certainly something, a retreat that we've needed really, this pocket of quiet for some time now. Now, that being said, right, so back to the AI story. So this is really one company that's really been central to this, apart from sort of Alibaba, Kingsoft, and all these other companies. Baidu, it's set to report today. We're not really seeing a lot of movement in the stock. The take from the folks at Bloomberg Intelligence, Robert Lee here, is that the earnings upside remains elusive, given, of course, all the exuberance around the AI story. Just to quote Robert directly, that 4Q results will likely undermine any residual confidence in its growth prospects as the outlook deteriorates further. Okay, don't shoot the messenger. That's Robert's take right there. Watch for what the company reports and says going into the U.S. reopen today.
But in a way, this is the issue that keeps coming up in our conversations with guests and investors. It's key. It's the monetization problem. And for Baidu, that seems to be a real sticking point for investors, particularly as we go into earnings.
Yeah, I remember Hao Hong out of Grow Investment was here. He joined the Asia Trade Show earlier on, and he made a very, very good sort of analogy and example of, Chinese are not used to paying for software, which goes into the broader issue here as well. And it will be critical really for them to find out how they're able to monetize this. The point that Goldman Sachs Kinger Lau was making earlier on was that based on their assumptions and models is that AI will add 2 or 2.5% incremental earnings growth to Chinese corporates over the next few years. Now, how they came up with that number, I'm not too sure, but that underpins their latest index target revisions on Chinese tech as well. Okay, very quickly. Okay, there's no really easy pivot for this from AI to spicy noodles. There we go. Toridel offering to buy Tamjai, which is a very, very popular restaurant chain here in Hong Kong. $1.58 a pop. We were at $1.46 before the news came out of 56. So we were, in fact, trading below $1 there. Hong Kong dollars. We're up 62% as we speak. Okay, very quickly, some other movers to tell you about. Energy stocks on the up. China's aiming for stronger new energy storage industry in a couple of years. And, of course, we'll end with a look at some of these Chinese healthcare names that are continuing, in most cases, to see some upside here. Alibaba Health and JD Health, of course. So we had a pause on Monday, but last week these were really some record-breaking moves we're seeing in this, as really the AI play complements their product offering. Right, coming through, speaking of earnings here, Mike Henry out of BHP, the CEO, joins us to talk us through their recent earnings. Good on most metrics, a drop in profit, and a smaller dividend. That's next. This is Bloomberg.
Good morning and welcome back to the China Show. Here's a look at the HSI. About a half an hour into the session, we are higher, about 0.9%. Dave was saying earlier, a sort of somewhat quiet day, a little moment of reprieve, but maybe we are slowly backing into a sustained rally coming in through the day.
Yeah, some sense of normalcy. Finally, after, 2 or 3 weeks of quite exuberant market moves, volumes coming through.
It's been a pretty steamy rally. I mean, especially when we think about that southbound connect and a Hong Kong story, really. Yeah, I mean, very concentrated, to your point. I think turnover yesterday onshore was close to 2 trillion. We were, the fact that we're keeping an eye almost on an hourly basis on southbound flows is indicative really of how concentrated this market has really become. Now, that said, we're also getting a lot more sell-side coverage suddenly coming back online for a lot of these stocks, which, by the way, had taken really a back seat. If you think about it, it was quiet as a manger in December. It suddenly turned into a race, an adventure, maybe a hint of danger. We'll see going into the next couple of weeks or so. Morgan Stanley just dropped his notes in our inboxes, and the big story, of course, in Chinese tech this week. Jack Ma returns. But will animal spirits is the title of that report. We'll unpack that later on from Robin Shein and his team. I think the central thesis, though, just to give a little bit away, is that China still needs more consumption-centric reform and stimulus to sustain the return of corporate confidence. And certainly this is really a good window of opportunity. As you can see, some of these names are up 6% on Xiaomi. Very quickly, Asia ex-China is looking like this. We've just about wrapped up. Still a few names left, but largely speaking, we've wrapped up earnings season in Japan. We're in the thick of things in Australia, of course. ASX 200, 0.5%. In fact, just on that very note, the BHP was the big one, which reported a couple of hours back. Quite a very long earnings statement, 70-plus pages PDF, so I had to print just a few pages of that. Double-sided, just in case you're getting upset on that. So most metrics actually came in rather strong. At least that was the front page of the earnings statement, as you would expect, really, from the corporate. You really had to dig deep into some of the weakness coming through here. But the Bloomberg headline tells you everything you need to know, at least on the headline basis here. Was it earnings miss? And then some of the losses and maybe some of the pricing that come through here as far as iron ore concerned. And, of course, the dividend not quite as strong as initially anticipated. Let's bring in Heidi Stroud-Watts, of course, our Asia Trade co-anchor, to talk us through her take here on these earnings, Heidi.
Thank you, Dave. Good morning, everyone. Thanks for having me. Well, I think the headline is Yeah, and of course, so much of that story when it comes to the weakness out of China is what we want to talk about, right? And whether there are prospects for that recovery. Let's bring in Mike Henry straight away for his views. Of course, he's a CEO at BHP. Mike, really great to have you with us to go through these numbers. I do want to start off with China because that sort of faltering economic outlook and demand was really one of the biggest contributors to the weakness for iron ore and the demand story. I do wonder, how do you characterise that demand story going forward? Where do you see prices at and how confident are you?
So, look, I'll start with the last half performance, which was another solid operational and financial performance for the company. Good cost control within the business and production firing on all cylinders right across the business. You look at our iron ore business with record shipments for the first half, notwithstanding some of the pressures in the iron ore market that you refer to. Production in our steelmaking coal business in Queensland up by 14%. And the real exciting story here is copper production up by 10%. And that keeps us on track for 24% growth in this very important critical mineral over a 3-year period to the end of this financial year. Now, what are we seeing by way of near-term commodity demand? Yes, there has been some overall economic challenges or headwinds in China, but the sectors of the economy that are important to BHP's commodity demand, for the most part, have been performing strongly. The exception, of course, is the property sector. That has been under some pressure, but we're starting to see some green shoots there by way of increased new starts, property price rises in some sectors. So I think we'll see some momentum building into 2026. And we also expect that with a pro-growth stance having been reiterated in China, that they will calibrate their policy measures to ensure that the domestic economy stays on track or continues to gain momentum. And they'll calibrate those measures based on what they're seeing in export markets, with there obviously being a heightened degree of uncertainty there currently given policy settings in some other jurisdictions.
What's your forecast and I guess your level of preparedness when it comes to tariffs, of course, on China, but also potentially global tariffs, threatened, expected, but not fully into play yet? How does that impact both demand side, but also across supply chains and broader operations?
So, great question. Obviously getting a lot of attention on the part of everybody in the markets currently as to where that ultimately lands. And the reality is that we don't know. It's going to be weeks or months before we know where tariffs and counter tariffs ultimately settle. Having said that, BHP is a business, given our strategy and our portfolio, that is positioned for all worlds, including a world of heightened uncertainty. We've got commodities that are not dependent on any individual thematic, so they're broad-based in terms of their demand, both by the markets that they sell into, as well as their end use. And within those commodities, we have assets that sit at the low end of the cost curve, which gives us more resilient margins than the competition. So we're a full 10 percentage points ahead of the competition when it comes to our average margins. So that places us very well for a period of heightened uncertainty. And given the growth optionality that we have in the business, if the global economy stays on track, it continues to grow, the world's going to need a lot more of the metals and minerals that BHP produces. And we're right at the forefront of our ability to meet that growing demand.
I want to ask you about capital management, clearly of utmost importance, that interim dividend cut to the lowest since, I believe, 2017. Does that indicate a change in strategy, and where are you sort of focusing that capital discipline in other parts of the business?
So what it indicates is that we're bringing exciting growth projects forward. So part of what you see there is increasing investment in future growth and future-facing commodities to ensure that we maintain strong value growth and returns for shareholders over the medium to long term. The reality is that over the course of the past 5 to 10 years, we were in the closing stage of executing on some legacy growth projects, and then we didn't have a lot of attractive growth to bring forward in the near term. So we spent a number of years now building up that healthy pipeline, very strong pipeline of future growth options, predominantly in copper and potash. And as we bring those forward with the attractive returns that they have, we'll see the capital allocation framework that we put in place back in 2016 come to bear in exactly the way that it was intended, which is to protect the balance between cash returns to shareholders and reinvesting in the business. We do have a minimum 50% payout ratio, as you may be aware. And we've been paying well in excess of that for a number of years now. But as we bring these attractive growth projects forward, we'll see the two legs of that come into balance. And then for that pipeline of cash that we are able to apply into growth, there's a healthy competition between projects and BHP to ensure that we're striking or investing in those projects that are going to create the greatest value and greatest returns for shareholders.
Mike, David here. And just to clarify, that's a very good point you bring up. It's a good problem to have, let's put it that way, that now you're looking at other uses of that money. You mentioned the minimum 50% payout. Can we assume that remains to be the case, given all the cyclicality and, of course, this sort of trade-off between future projects and giving back money to shareholders?
So you can assume for certain that we take that 50% minimum payout ratio very seriously, and it's something we've had a lot of positive feedback from shareholders on. But what I don't want to leave you with is a view that says that would be all that we would pay out over time, because in any given period, we take into account the opportunities that we have directly in front of us to deploy that cash for best returns into the business, but we weigh that up against further cash returns to shareholders. We weigh it up against strengthening the balance sheet, possibility of buybacks, and so on. So every time that we come to the end of a period, we sit back, look at the pipeline of attractive growth projects in front of us. We weigh up those opportunities against or alongside opportunities to return more to shareholders or to strengthen the balance sheet. So it's a period-on-period decision, but always protected on the downside by the 50% minimum payout ratio.
And to the upside, one of the bright spots was obviously copper. With the amount of money that you're set to spend on the Chilean part of the portfolio, it seems like the return will be quite limited. And I do wonder, what's your strategy for looking at more copper growth, right? Is it sort of mostly organic? Where is that? Does inorganic opportunities still play a part here?
So, as you would expect for a company of our size, from time to time we'll look at external opportunities. But what I hope really shines through as part of this results presentation is the progress that we've made in terms of developing our internal organic options for copper growth. And we provided a bit more detail on those in this presentation, where we outlined that from a capital intensity perspective and from a returns perspective, our projects in Chile alone are very attractive relative to competitor brownfield and greenfield projects, and certainly relative to the implied capital intensity of inorganic options. And that's but one option within our suite of copper growth options, because we also have Copper South Australia, where we've created an exciting new basin opportunity there. We have a project in the US, along with one of the others in the industry, called the Resolution Project. And in Argentina, we've recently invested alongside Lundin Mining from Canada in one of the world's best undeveloped copper resources. So we have attractive growth options now across 4 different jurisdictions: Chile, Argentina, the US, and Australia.
Can I ask, is interest in Anglo-American off the table now? Is that completely dead, or is it just sort of cooling for now? And if not, sort of, are you keen on other big ticket assets like that?
We are 100% focused on progressing our pipeline of options in copper. And I've been very clear and consistent on this. We've made progress on these organic options. And that's where all of management's focus is right now. And I get why sometimes there's speculation or questions that arise around external opportunities. But I really do want to leave you with the fact that all of our attention is on progressing this very attractive pipeline of growth options that we have in copper and potash.
If you were to look at another target, what sort of attributes would you be looking for? Because I think a lot of the conversation broadly across M&A in the industries is that it's been quite wasteful in the past years. Do you think kind of broadly we're heading into more of a period of consolidation and efficiency?
But this is why we are so disciplined about this. And we have always been very clear that BHP will never be reliant upon acquisitions or external opportunities. It's one lever that you would expect to see a company like us have in our toolkit. But we are all about creating shareholder value. And I think in the current market, it's become increasingly difficult for companies to pursue large-scale M&A for value. And that's what we're all about. And whereas if you look at what we've done internally with our growth options, we've got this very healthy pipeline, much healthier pipeline now of growth options in copper, in potash, for attractive capital intensity, attractive returns. And so that's where all of our focus is.
Potash is probably one of the outliers, right, in terms of delivering more than perhaps what could be characterised as incremental growth. What would be your best strategy then to be able to get ahead of some of your competitors that might be doing a little bit better when it comes to the production side, if, as you say, inorganic targets are not what you're focusing on?
So we've got the two big investments going now into Jansen Stage 1, Jansen Stage 2, the world's best undeveloped or greenfield deposits of potash. And this is going to be right at the low end of the year in the first quartile of the cost curve, so low end of the cost curve, meaning that at all points in the cycle we expect it to be cash flow generative or positive. And these are resources that will allow us to produce for decades to come. So the long-term returns for shareholders arising out of potash are going to be very healthy, attractive. And we're building essentially a new commodity pillar within BHP. So whereas in the past, iron ore has been a dominant business within BHP. It's still going to be a very strong, healthy contributor to the company, but we're growing copper alongside that. 39% of the company's EBITDA this past half coming now from copper. We'll be growing up large scale. We'll be one of the world's largest producers of potash in short order. And then finally, we have the world's highest quality coke and coal business in Queensland. So we'll have four very strong businesses on a go-forward basis within BHP, all contributing significantly to the group. And we'll have a particularly resilient portfolio given the commodities that we're in and where we sit on the cost curve.
With that renewed focus on copper, where do you see, where does your forecast fall when it comes to prices?
I'm sorry, that was in copper?
That's right.
So in copper, we've seen consensus pricing in copper, say 12 to 24 months ago, rise from $3.50 to $4.50 per pound. We've been very clear that we see the demand outlook for copper being both resilient and strong. Potential for up to 70% growth in copper demand between now and 2050, driven by growing global population, rising living standards, decarbonization and digitization. So we do expect that copper prices are going to be supported by the need to bring a lot more capital into the market, potentially $250 billion more capital just in copper growth over the course of the next decade. And that's against a backdrop of projects becoming harder to find, more expensive to develop, and more risk to be managed. And that's why having a portfolio like BHP has, with the world's largest resources, more growth options now, and a strong track record of being able to execute large capital projects on time and on budget, positions us so incredibly well.
Mike, always a pleasure to have you with us. Mike Henry, CEO at BHP. Dave.
Yep, fantastic there. Heidi, great stuff. If you're a Bloomberg subscriber, you can, by the way, catch up on all the interviews you might have missed, in case you missed that one, of course, just now. And some of the others these last few hours or so. TV Go on your Bloomberg terminal. Join the conversation too. So send us instant messages. If you have a question in, burning one, get them in as quickly as you can. And I promise we'll do our best, of course, to get that to the relevant guest. Check it out, TV Go for our Bloomberg clients.
Yeah, and meanwhile, Singapore's Aviation Festival Asia is getting underway today. Bloomberg's Avril Hong is there with a look at what's in store for us. Avril.
China's travel recovery is in the spotlight after a promising start to the year, especially for domestic tourism. How bullish is the outlook for the rest of 2025, and how much can this underpin the growth for APAC? Plus, what are industry players doing in terms of diversification amid China's slower than expected travel recovery? We'll get the view from World Travel and Tourism Council President and CEO Julia Simpson. This is Bloomberg.
All right, there we go. The countdown to what likely will be, based on most, not all forecasts from economists, the first reduction to the cash rate out of the RBA since Rona first hit back in 2020. But if you certainly compare the levels right now, not just on government yields, but in the cash rate itself, to 5 years ago, I mean, were multiples higher than the current level. So this is perhaps the start there of a longer-term rate-cutting cycle there for the RBA.
Yeah, as you say, most economists expecting to see the beginning of an easing cycle, albeit perhaps with the RBA maintaining a slightly hawkish stance. Let's bring in Isaac Poole, CIO of Ascalon Capital, to help break that down. I mean, let's just start with the RBA, Isaac. What are you expecting to see? We'll get that decision in about an hour or so. And how low do you think the RBA will go in this easing cycle?
I think the RBA is going to cut. It's very widely expected to do so, and I think this is the start of a fairly lengthy cutting cycle where we could have rates below 3% relatively soon, certainly by the end of this year, as the economy continues to soften.
All right. Well, is there an investment takeaway as far as the equity market, specifically in Australia, is concerned, or is there a broader play here?
Yeah, I mean, I think that what the RBA is doing is cutting rates because the economy is slowing, and we've seen weak earnings growth, weak sales growth in Australian equities for some time, but the market hasn't cared. It's just kept pushing it up to higher prices and higher valuations. I think there's a lot of downside risk here in the Australian market. It looks very overvalued.
Okay, so if it's not there, where else are you looking to deploy your money currently?
I think you want to be overseas, and in the US still equity markets look better than other parts of the world, but they're still very overvalued. So for us, when we look around the world, rates are starting to be cut. We think we'll see more cuts this year. That suggests get into government bonds, particularly US Treasuries, where yields are looking still fairly attractive.
Isaac, what about the China story here? We've obviously had a slower introduction of tariffs than most were expecting when it comes to China, but still there's expectation that we probably get up to 20%, 30% this year. Where do you see opportunities, if any?
Look, I mean, Chinese equities look pretty well valued in a relative sense, so there are some opportunities there, but you need a catalyst to realise that value, and I don't really see that coming through as trade wars continue, and as you suggest, I think they will intensify. There is some opportunities there. Of course, overnight we see some opportunities in the tech sector in China, where I think that will become a big focus and unwind some of the challenges that sector has faced over the last few years. But overall, I think this is a market where you don't want to have too much exposure to still.
Yeah, let me push in that a little bit to Isaac. Why do you think the DeepSeek moment was not that catalyst? Because if you look at the market, we're up 30%, so certainly it does seem something has happened.
Yeah, it has. I think there is some realization there that sector in particular was deeply undervalued, and we've seen that unwind and some growth. But it doesn't suggest that has to continue ramping higher. I think we may have seen some of that already repriced in.
Isaac, do you have expectations around the MPC? Is there a base minimum that you want to see coming out from policymakers next month?
I think that what we've seen over the last few years is that there's a lot of talk, a lot of words, and the follow-through has been incremental at best as policy support has been drip-fed out. I don't think that's going to change. I think we could see a lot of talk, a lot of, hey, we're supporting the property sector, we're supporting the economy, but the reality is growth is slowing structurally, and that's not going to change, I think, in China in the near or medium term.
Right. So far we've discussed, I think one of the things that you point out is where there is risk-reward good values in treasuries. Do I take it then that you still feel that high yield, for example, which has done well, remains expensive for you're not getting the reward you need given the spread?
Exactly. The spreads are just so tight that we look out over the next few years, and I just can't see the sort of returns coming through that we've seen over the last few years. So for us, not a great place to be. If you want to get a little extra yield on top of treasuries and govies, then it's the investment grade where you want to go. And we think short spread duration. Don't take on extra interest rate risk and credit risk where you don't need to. If you want that yield, go to good old-fashioned IG.
There we go. So IG and govies is the takeaway there. Isaac, fantastic to speak with you. As always, Isaac Poole, the CIO at Ascalon Capital, joining us today to talk us through his market calls there. Hang Seng Index, 1.2% going into the first hour of trade. The Tuesday session will break down some of the movers that underscore this price move currently. This is the China Show. Right, welcome back. So you had a really big move in European equities overnight. A lot of that was also the fact that you had defense-related stocks pushing substantially higher going into the close. That's we're seeing that as well, somewhat broadly. Same story here in Japan, also in South Korea. Very quickly, we'll leave you with a look at energy storage stocks. These are traded, of course, onshore in mainland China on the back of this plan, of course, to increase capacity going into 2027. Substantial gains there, as you can see, limit up in some cases. We'll dig deeper into this AI story coming up next here on the China Show. Stay tuned for that.
If you look at back in the 90s, right, so when Windows was first introduced to China, right, so basically 99% of the copies used in the market is actually pirated copies, right, all the way until like 10, 15 years later. So, you know, it's a difficult market to monetize. I think it's still very early stage. It's a huge breakthrough, but then at the same time, you know, for now, I don't see a good way to monetize it.
There's still a lot of uncertainty in terms of how we monetize and how we use AI. But as I mentioned earlier, if you think about really the medium term to long term, I think you can make a pretty credible case that AI should be conducive to corporate earnings, right? So, I mean, there's the optionality, I think, is not fully priced in the equity market.
And then, of course, we've had the meeting of Xi with various tech leaders at the broader tech industry. And I think that's a positive. I think it shows that the goals are aligned. But again, the market hasn't not taking it with additional, let's say, support in a rally sense, again, because we've had a meeting in 2018. And again, the consequences or the evolution of that has been somewhat different to what was, again, stated in 2018.
Yeah, there we go. Some of our guests just this morning here on their views on this AI-fueled equity rally, which, by the way, is resuming today, not to the extent that we had previous sessions, but certainly we are seeing some upside across some of these names. Might be down to the fact that you are getting buying coming through again across the Stock Connect. So in the first hour of trade, the inflows across the Stock Connect southbound into Hong Kong from the Chinese mainland has, as you can see, largely been positive. Now, it's also worth pointing out that this is an intraday chart, which tends to, we've seen some changes as the session progresses. So we're keeping an eye on this very, very closely today.
Yeah, I mean, Baidu is one of these names that very much is in focus in the context of that tech rally. Essentially, can it work out how to monetize here? So we have fourth quarter earnings, which may provide investors with some clues on whether the firm's lagging share price performance is warranted or not. The company will be kicking off the hotly anticipated China internet earnings season in just a few hours. Let's bring in our China correspondent, Min Lo. Maybe just lay out what we should really be watching for and looking out for when it comes to earnings.
Yeah, the earnings outlook not looking very positive on most of its business segments. You look at the ad revenue, core ad revenue, expected to be down by about 8% in the last quarter through December because of that weak consumer sentiment that continues to persist. If you look at the search engine profits, that's under pressure as well, given the intense competition from the newer players, the social media apps that are competing in the same sector. And you look at its AI ventures still struggling to monetize. Baidu expected to still make losses on its AI investments for the next 3 years. Yes, there is a greater contribution, but limited contribution from that Ernie chatbot and intense competition from the likes of DeepSeek, Alibaba. And so its adjusted net earnings for the last quarter expected to be down by about 38%. Sales expected to be down by 4.5%, which will make it the worst performance since the second quarter of 2022. So yes, Baidu is riding that tech rally. It's up about 8% so far, but it's lagging behind its other rivals like Tencent and Alibaba, which is up about 50% year to date so far.
This comes, and the big news, of course, you guys were talking about on Monday was the symposium that was chaired by the Chinese president. You had the who's who of tech except Robin Li.
Yes, except Robin Li and some others. And this is interesting because there were so many representatives across the robotics sector, the AI sector, the semiconductors, the EV sector, and Baidu ostensibly wasn't there. The founder, Robin Li, wasn't there. And you would imagine if presidency hands you an invite, there's no way you're going to turn it down. So the question is, were they not invited? And if so, why? Like, does it mean that this company is falling out of favor with the authorities? Or does it mean that this is a company with waning influence that is losing its edge given it's in a space where there are so many new competitors that are making a lot of breakthroughs and disruption on that front? Other prominent companies that were not present, the founders of ByteDance, JD.com, Pinduoduo, which for these other companies, it might be understandable because Beijing has hinted that they may not want to keep fostering more live streaming apps or e-commerce platforms. They want to focus on the new productive forces, the cutting edge technologies, the chips firms. So that might be understandable, but Baidu is a bit of an outlier there. So interesting to watch what unfolds in the next few weeks and months.
Min Lo, our China correspondent, something that happened, I think, a few months back, to Min's point, if you get an invite from high-ranking Chinese officials, you go. And I remember Elon Musk even got on a plane. Remember that? When he made his way into Beijing. Now, Bloomberg Economics, just on the story we were just talking about there, President Xi's meeting with private sector businesses sends a signal that Beijing is trying to revive animal spirits among entrepreneurs. Let's bring in Eric Zhu to discuss the impact here. And yeah, what's your take here?
Yeah, I think yesterday morning, I think many equity investors, they're busy trying to IDing the faces on the TV screen, right? Who's participating in the meeting. But for us, I think we look at a big picture. It's China's push for the high-tech businesses. Right? But if you remember 6 years ago, in 2018, I think they had a similar meeting, with private leaders. And I think some tech leaders also appeared in that meeting. But compared to that time, I think this time you see more faces, new faces of those the so-called new high-tech, right? So more EVs, DeepSeek's leaders or AIs. I think that's confirmed. Also, I think that's a signal that confirming that China is on the track, for pushing the high-tech development, especially the success of DeepSeek. I think it shows that the strategy is working, and it also adds to the need that the policymakers still need private sector, on the innovation, on the high-tech push, right? So, who makes the breakthrough? It's DeepSeek. It's not just SOE, right? It's a private sector. So I think that's something that probably trigger, in part triggering the meeting this time. So she wants to send a stronger signal that for what we're trying to do, pushing forward high-tech development, we still need a strong private sector to participate.
For those who have been monitoring the crackdown, not just on tech, but on the private sector at large, you may remember that back in November 2018, the perception at the time from markets and investors and even some economists was that actually this was a signal of support for the private sector. It was misinterpreted, and it took quite a few months for the recalibration, for markets and investors to really understand, actually, we were at the beginning of a crackdown, a years-long crackdown. Yeah. Why? But you've sort of crunched this really interesting census numbers on how we've seen actually employment and business entities shift that does show that the meeting this time is different, and potentially we're not at the same risk of misinterpreting.
I think back 2018, that's a peak of property market, right? The property boom. I think we have data from the economic census showing that actually 5 years later, in 2023, the employment in construction and the property developer, it's already shrank by almost 8 million. So 8 million workers left those sectors. And at the same time, 10 million workers were added in IT and research services. So that's a representative of the high-tech business. So it's a very clear shift of the economy. And I think this time the meeting just tells everyone that, okay, China is on the right track, and we still need your support and need your, investment, need your innovation to move this a further step forward. But I don't think it's a U-turn, on the crackdown. I think there's still oversight, there's still regulations, but I think especially Jack Ma, reappearing the meeting, that shows that the policymakers are telling the market that we need to move on, right? The past is past.
Interesting, because Morgan Stanley, Robin Shing, your peer in the industry, put out this note just now, and Rebecca and I were talking about this earlier, that, they posed the question, Jack Ma returns, but will animal spirits? And the other thing that they point out there is China still needs more consumption-centric reform and stimulus to sustain the return of corporate confidence, right? My question for you is, clearly AI and EVs, as another example, is an example of the successes of industrial policy. Can they pursue both? Can China afford to pursue both successful industrial policy and also a sort of consumer-oriented reform?
I think it's not contradictory, but in some extent, we also published a note last year, so I think it's interesting talking about, the cutthroat competition in China. So I think it's also, you can observe even from new economy sectors. We talked to some clients, from EV sector. They are complaining that the working hours are too long, right? So they're competing is too fierce. So I think to some extent that's actually crowding out the consumption, because young people, they spend all the time on working, they just don't time consume, they don't have energy to consume. So I think it's the direction is right, but I think the culture or the institution needs to change, because trying to foster a more healthy competition instead of the competition we see right now. It's too it's making everybody tired. So I think that's a thing the policymaker need to give more thoughts.
Okay, a new kind of competition. Everyone's tired.
Yeah.
I mean, let's see. Let's watch for
difficult.
the MPC. Yeah. Talking about that interesting cultural shift that's needed here. Eric Ju from Bloomberg Economics, thanks so much for joining us. And there's plenty more ahead. We are live at Aviation Festival Asia in Singapore next. This is Bloomberg. The Aviation Festival Asia conference is underway in Singapore, bringing together top global executives in the airline industry. Let's cross over to the event where Bloomberg's Avril Hong is standing by with our next guest.
Yeah, guys, China's travel recovery, the rebound is really in the spotlight. And we had a really solid start to the year, especially for domestic tourism. What is the rest of the year going to look like? Let's pose that question to Julia Simpson, President and CEO of the World Travel and Tourism Council. Julia, thank you for stopping by. When you look at China, how bullish are you in terms of the outlook? Is this the year we see travel back at pre-pandemic levels?
Well, in the year of the snake, I'm very bullish, put it that way. Chinese travellers are on the move. All our companies, I represent the private sector in travel and tourism, so we have major Chinese companies like Trip.com, all are reporting, Macau, all are reporting record numbers of Chinese visitors visiting the rest of the world. And it's one of the fastest growing. Of course, it was a bit slow post-COVID, but now that it's found its feet, it's growing very, very quickly. And we're expecting the Chinese travel and tourism economy to outstrip the American travel and tourism economy, which is the biggest in the world. So it's going to take that spotlight probably in the next 5 to 6 years.
So in terms of the numbers, is this going to be the year where we see 2019 levels then? Are we going to go beyond that, exceed that?
Yes, I think this year for China, we're going to be looking at exceeding 2019 numbers. Clearly, after COVID, it took a while to get the visas sorted, but the Chinese government are making some very, very smart moves. So, for example, they've been relaxing visa policies in Asia Pacific. So we're seeing a lot of Chinese arriving in neighboring countries, if you like, and everybody wants the Chinese visitor because Chinese visitors, one, they're absolutely phenomenal, but they're also very, very interested in discovering new cultures. They particularly like what we call the great outdoors, but they're also very, very good shoppers. So people are very keen to attract Chinese visitors globally.
How much are they really spending though? Because, I mean, against this backdrop of wage growth uncertainty, job uncertainty, how much are they splashing out when they're overseas?
Well, what's interesting is you're right. Inflation has impacted the Chinese resident as it's impacted everybody globally. But the research we've done at the WTTC shows that people are still prioritizing travel. They're prioritizing the experience of a lifetime over buying things. So it's really interesting that we're not seeing any softening. In fact, we're seeing a growth in the Chinese traveller market.
And to what extent is this going to underpin APEC's growth for the next couple of years?
APEC's growth is now, going to be growing at 20% year on year this year compared to last year. It's the fastest growing travel and tourism region in the world. Yes, it had from a slower start, that's true, and the Middle East was the fastest last year and is very, very strong growth, and they're investing a lot of money. But if you look at countries like Vietnam, if you look at Thailand, Cambodia, we're in Singapore. Singapore's really going gangbusters. Singapore's numbers this year are more or less, in terms of value, they've exceeded 2019. In terms of volumes, we're still around the 2019 numbers, but Singapore is taking off. So the whole of Asia-Pac. And also what's fueling that is the big innovation, the innovation mindset. We saw, DeepSeek, take the world by surprise. But the truth is, you've got fabulous tech companies, startups that are moving faster, more efficiently and more cheaply, and they are revolutionizing our sector here in Asia-Pac.
So it's business travel that you see it almost fully returning or exceeding?
Business travel, we didn't think globally that we'd get it back by 2025, but actually it came back full last year. Asia-Pacific, it is happening. We're here in Singapore, an aviation summit, and we've got thousands of people here.
But business travel is also kind of always, since the pandemic, been a bit of an uncertain one for carriers, right? How sustainable?
No, it's coming back. It's come back to pre-pandemic levels already, which we're really pleased about. And, business travel represents about 20% of all travel, but it's a higher value. So it's a higher margin travel. So it's very, very significant. But I think what all the aviation carriers realised is before maybe they would have prioritised the business traveller over the leisure traveller, not as explicitly as that, but in terms of revenue, wealth, if you like. But now the leisure traveller has a lot of money, and there's one of the big themes we're seeing is luxury travel. So luxury travel with very wealthy people having a lot of money and time and desire to visit new places is definitely one of the strong trends we're seeing.
What about the potential headwinds? I mean, there are still some of these uncertainties surrounding US policy, surrounding the economic trajectory, and that could have knock-on effects for price pressures potentially coming back to the fore. Maybe growth slows. How is that potentially going to shape travel demand?
Well, what we're looking at, I've been looking at all the big results of the Hiltons, the IHGs, the big travel companies, and they're looking at 6, 7, 8% growth this year. IATA, which is the global body that looks after airlines, and airlines, of course, are a bit constrained in their growth because we haven't been able to manufacture enough planes fast enough post-pandemic, but nevertheless, they are looking at a growth of about 10%. So our sector is growing at about double the rate of global GDP. And, people talk about the Trump effect, but Trump, at the end of the day, he likes golf courses. He's a retail expert. He believes in travel and tourism. We're going to get stronger over, the next few years.
So good for business, good for travel, Trump is. But, you raised what we're seeing in the airline industry, something that's come to the fore today as well, aviation safety after yet another incident. I mean, what are you hearing among industry players?
Well, the first thing I want to say is these are terrible tragedies when they're happening, and our hearts go out to the people and the families that are involved in these accidents. But you have to look at it over the longer term, and aviation is one of the safest forms of travel, and it is safe because they really believe in a culture of safety. They have one of the most open and highly prioritized safety culture. They wouldn't have a permission to operate.
Right.
So
but travelers are still worried, understandably so.
Yes, I mean, of course. But, and I don't want to say it like this, but, there will be many, many more people that die on our roads, sadly, than we will see in aviation incidents. So while, our hearts do go out to the victims and the families today, we need to remember that aviation is a very, very safe way to travel.
Touching on some of the economic uncertainties, is there a case to be made in terms of the travel industry's contribution to growth, job creation, particularly for developing Asia, that presents a sort of buffer from the global uncertainties?
Oh, absolutely. In Asia Pacific, we're expecting over the next few years to add 64 million jobs. And to bring it up to about 340 million jobs here in Asia Pacific. So travel and tourism generates a lot of jobs. I'll give you the way I always put it. Of every $10 made on this planet, one comes from travel and tourism. And of every 10 jobs on this planet, one comes from travel and tourism. And also, we're a great employer of women and also young people. There are very, very few businesses where you can start literally cleaning bedrooms and become a CEO. But that is what Chris Nassetta did of Hilton. So we provide really great career paths. Right. And also in some developing countries, actually, we lift people out of informal economies into the formal economy where they're paying taxes. Travel and tourism this year will deliver $3.3 trillion to governments' exchequers just by the taxes that all of us pay when we're working in our sector. So we're a real engine for jobs, for tax income, so that countries can reinvest that in building hospitals and roads and whatever they need to build. So we're a force for good.
Definitely a key component of economies. Julia, it was really great to chat with you. Thank you for coming in, sharing your insights with us. WTTC's President and CEO, Julia Simpson. Guys?
Avril, fantastic. Avril Hong there in Singapore for us. And for our Bloomberg clients, you can check that out, that interview, and some of the other ones you might have missed. TV Go is the function that you run to send us instant messages. For lots more coming up, of course, they're on the ground with Avril as well. Yep, so major source of growth, hiring, and, in my opinion, unnecessary selfies. Travel. Okay, anyway, that's my rant for today. Plenty more ahead. This is Bloomberg. Right, welcome back. Just before we wrap up the show today, just a look at the rally which is resuming today. So in Hong Kong in particular, of course, and really the concentration of this. So we're up 300 points on the Hang Seng Index, which now puts us just about 100 points now short of the peak that we hit back in early October of 2024. We're just within half of 1%. The graphic's going to show you this. But again, it's maybe time to take stock over how you read into many of these things, and the timing, certainly, as we try and close the chapter to this regulatory story?
Sure. I mean, I think it's believable that, true, we look at the economy, the shifts of what's happened in the private sector. Yeah, there has been a line drawn under the sand. But I can't help but remembering back in November 2018, we had this similar symposium and the market almost universally interpreted it as positive. Just a few months later, we had common prosperity. We had talk of barbaric capital. It was a complete misinterpretation and misstep by the market. So, you know, I don't want to be a Debbie Downer, but it's always in the back of my mind as we interpret what this symposium really means.
Yeah, that's right. In 2018, much of the same group was in the same room.
Sure.
If you think about it that way. And certainly with the exuberance in markets right now, it's certainly, I guess, a useful mental exercise to be cognizant of the risks that are not too obvious right now. But, I mean, this market is really still more about momentum than it is fundamentals. It could shift even further. Let's see what happens here. Thank you for joining us today.